Most bad deals don't fail on spreadsheets, they fail in our heads. In this episode, we're going to dive into the 10 biases that can quietly sink real estate decisions, how they show up in multifamily, and the simple habits, rules, and meeting rhythms that you can use to neutralize these biases. Mark, so good to be here today.
Yeah, John, it's an interesting topic we're going to be going over. When you get into a deal, it's really good to understand some of the tricks that our minds play on us.
Yeah.
And we're going to be diving into the 10 biases that you got to really watch for when you're buying real estate deals. And if you haven't checked it out yet, go to fulloutinvesting.com to find out a little bit more about what partnering with us would actually look like. There's a sample deal on there at fulloutinvesting.com. And if you do, you'll get a really good understanding of what the potential return metrics look like, what our overall approach is, and to find out a little bit more about what Faris Capital Partners can deliver for you. So yeah, John, the 10 biases, this is going to be a good one. And I
Yeah.
think when you're looking at deals, it's really important to not only look at the key metrics, but then to look at where you're actually at into the frame that you're currently sitting in, and then looking at context as well as to, are you? We'll just say the biases.
Yeah.
We're going to be diving in, and our minds play tricks on us. So I'm really excited for this talk.
Yeah, yeah. If you haven't read the book Thinking Fast and Slow by Daniel Kahneman, he actually talks about a lot of these biases and how they show up in our lives. And, a lot of it relates back to, a few hundred years ago, like when, we were a lot more risk at all times, right? In terms of, danger and things around the corner. And so our brains have developed these mental shortcuts to say, should I trust this person or should I make this decision? And while that can be helpful, if not watched and monitored closely, you can let some of these biases, inform your decision making in a way that could be potentially problematic, right? And as you know, Mark, what often happens in our business is when we get a deal, we got a lot of time pressure, right? Because good deals don't sit around for a long time. And so, if not careful, that pressure can create those mental shortcuts that we're looking to avoid here, right? And so, bottom line is when you have disciplined rules and processes and systems in place for how you underwrite deals and your sort of like things you will always say no to, it can help you avoid some of these. So diving in will be a lot of fun today. So here's the 10 biases that break multifamily deals. First one, Mark, is anchoring, right? And sort of the trap there is when sort of like the asking price guides decision making. That's just like one example. But so often what will happen is when the deal is marketed, they'll say to be determined by market, right? The pricing. But if you talk to the broker, well, the seller's saying they need 160,000 a door to make this deal work. And then that gets locked in your brain. And the next thing you know, if you're not careful, you're looking for ways to justify that price
Mm.
versus just looking at the deal as it currently stands, right? Regardless of what the seller might think, right? So, building out some systems. So, yeah, Mark, we've looked at a lot of deals and it's not often that we get a deal where we're, targeting higher, right, than that number, right? The numbers are often penciling out where we're 20% off. And so we've learned pretty quickly that, that data point is somewhat important to know on the front end, but not one you should be focused on, right? So, ensuring that at the end of the day, we're looking at the fundamentals of the submarket, the fundamentals of the market, what's happening at the property level, and looking at actual history versus trying to get out a crystal ball and saying, we think this will happen. I mean, at the end of the day, the data is there, and these data driven decisions will help you avoid that anchoring bias.
Yeah, for sure. I mean, and this can work both ways. There can be a property that is well below market value, you get really excited, and then you put in a bid, and the realization is that offering price could be selling quite a bit over. You could be putting in a
Right.
bid and not get it and be way off, and somebody else came in at the actual fair market value. And then the other way, it's like this really high price, and you don't actually explore that. You don't put an offer in, and you totally miss it, that opportunity. So looking at the price is one thing, but understanding, okay, where do the numbers actually pencil out that we believe this deal is actually worth? And one of the points here is like, okay, here's the listing price. You really like the asset, and you keep on trying to push the numbers to be able to get to that asking price. And the reality is the deal either makes sense or it doesn't make sense. And the
Yeah.
anchoring side of it is it's good to understand where the seller is at, but by getting something down on paper that you feel it's worth, sometimes you can actually get a deal even though it's priced higher. But then, on the flip side as well, you sometimes you might actually pay a little bit more,
Yeah.
even if it's well, well below market value, and it still makes sense to you. So, doing your own analysis is really important on this one.
Yeah, we kind of call it like a clean sheet underwriting, where underwriting is not based on, what somebody says they think the sales price is. It's just what does the data show, right? What are the rent assumptions? Where is their current in place rents? Where do we think we can get those rents based on that market data? And then allowing that underwriting to drive that
Yeah.
price, right?
And then playing it out as well, like, it's well known in Never Split the Difference
Yeah,
by Chris Voss. He wrote this great book, Negotiator. And one of the things he talks about is when you're negotiating, like, anchor your first offer, as in like
yeah,
going really low. And so we know that, with every single offer that comes in, we like playing it out, as in
yeah.
let's actually see. And I've seen so many deals, John, like you and I, we've negotiated thousands of sales, and what I've realized is that sometimes somebody comes in with a really low anchor, and because I'm like, level headed, and we actually play it out, all of a sudden they're paying close to asking price. It was
Right.
just the anchoring part of, they needed to go through that process of putting in a low anchor offer, really low. And a lot of sellers would just ignore them, and then the buyer has an ego and doesn't want to come back to the table. But if you keep the door open, a lot of times you can actually overcome an anchor when it's used against you as well. So it can be looked at in different ways.
That's right. Absolutely. Number two is confirmation bias, and actually, what comes to mind, Mark, is I read this really interesting book a number of years ago, and it was actually talking about wrongful criminal convictions. And what happens is, and this can happen in any sort of like, industry, it can happen in your personal life. It's not like a business thing, right? But this idea that sometimes when a police officer thinks they have a suspect, they start looking for the evidence that supports that assumption, and they miss the things that are maybe pointing to somebody else, right? And so in our context, it's almost like if your confirmation bias would look like seeking data that agrees with your thesis, right? And disregarding the data points that maybe are painting a different picture. And that's why it's so important. We talk about CoStar a lot on this podcast, and it is a great resource. But when I look at say, for example, rent projection analysis from CoStar, I don't just stop there. I go look for other data sources
Mm.
to confirm, right? Population growth. Thankfully, our census data is easily findable and searchable through different web platforms. So CoStar might say population growth is projected to be 7%, but the census data is saying looks like more like 2 or 3%. So checking multiple sources for your data and not just using sources that support your assumptions that you've already made. And it's an easy trap to fall into. And a great other example might be perhaps you've closed on a deal in a submarket and exited, and it went really well. And so the shortcut that your brain may make is, well, we've had success in that market before. We'll certainly have it again. But as we all know, past performance does not always predict future performance. And so, you go and look at the submarket data and you realize, oh gosh, there's 2,000 new units that have just hit the ground or are about to hit the ground or are under development. So, you can't just rely on what's happened in the past or success in a certain submarket, or perhaps a broker that lives in the market that just loves it and tells you, oh, you definitely need to buy here. In fact, it was interesting with one of our deals in Georgetown. I had that example. I talked to this broker. He's like, you can't miss in that market. You can't miss, and I was like all excited. And then I was like, no, I got to slow things down. Let's go verify what this guy's saying. And in this case, a lot of it came out, but you've got to look at multiple sources and don't allow, your assumptions to inform the data that you're leaning on, right? And so one of the things we do here at Faris Capital Partners to avoid this is when we're looking at a deal, even if everybody is totally aligned and loves it, we always look to identify risks and challenges that this deal could do, right? It's almost that SWOT analysis. Like, even though we love this deal and we love this plan, what could go wrong? And what are some things that we have to be thinking about, right? And so, forcing yourself to create 5 risks and 5 challenges for every deal will be a good way to help you avoid that confirmation bias.
Yeah, 1,000%. I mean, we see this in politics all the time too,
Yeah.
right? Like
Yeah.
it's like you think something and then you look for information to validate what it is that you already think is true, and that's really dangerous when it comes down to investing. The next one's recency bias. So it's if it's something that is true, very recent, that is going to be true today. And the reality is, in the real estate market, things can change very quickly. There can be a new development that gets launched right across the street from you that 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 wasn't the case, and it's easy just to say, oh, I looked it up, last quarter, 6 months ago, in a year. It's like we're good. It's like, wait a second, we need to continue to have an open mind and exploring and really have discernment, and not just think that, oh, just because it was good in the past or we had success there in the past, it's going to be the same in the future. And so this is something that you really got to watch for recency bias.
That's right. It's the idea that you should be looking at the latest data points, but really more heavily weighing the history, looking at, 5, 10 years of past performance and then looking at future projections for performance. There are times where, because I'm looking at these sub-market reports on a monthly basis where you will see a pop where, gosh, we had 4.4% organic rent growth this month, but like look back 2 or 3 months, was that normal or was that sort of an anomaly? And making sure that once again it's not just the latest headline that you're making your decision around or the latest piece of data. So using 5 year median growth averages, modeling flat and down cases, right? And that's part of our underwriting process, as Mark, doing those sensitivity analysis and worst case scenario analysis, understanding what our break even occupancy is, and modeling various scenarios on how we can get to the ideal exit, right? Because sometimes there are things that happen you can't control. I mean, certainly the pandemic's a good recent example of that, but these black swan events can occur, so you need to
Mhm.
have a plan beyond the perfect pro forma you put together. What happens if, right? But I think the main point here is not just looking at the most recent headline or the most recent data point, looking at history and really making sure that the trends are there to support what you're underwriting.
Yeah. Next is overconfidence or optimism bias. So this is you finally find a deal and it
Yeah,
looks good, and then you start selling yourself on it. It's like, yeah, nothing can go wrong. You get this overconfidence, and the problem with that is you start missing all the we'll say the potential pitfalls of the
yeah,
deal.
yeah,
And especially if you're a salesperson, it's very easy to be so confident in the deal that you sell yourself. And so that's one of the things that I've noticed with investors. I mean, through my journey investing, but then I've watched other investors as well. The ones that are more seasoned, they're a little more skeptical of
yeah.
all deals, which is
Mhm.
the right way to look at it. It's like, because everybody's deal is, it's the best deal since sliced bread, right? It's like
Yeah,
when they come to you, but the reality is there's a hidden skeleton somewhere. All
yeah,
deals have something. It's just, do you know what it is? And
yeah,
this is such an important thing to really look at.
yeah. Mark, it was funny, but my prior business partner, Mark Spain, and the word paranoia is a strong one, but he said, we always have to have a healthy level of paranoia at all times. And really what he meant by that is that, sometimes we would have 1 or 2 years where, maybe the wind was blowing out our directions with the market. I would say, 2021 was a great example post pandemic where we would sometimes list a home and get 80 offers on it. And you can start to get into this, mode of thinking the party will never end and we can just kind of rely on this happening. But, eventually those things do stop. And so that paranoia, what he was really referring to is thinking ahead of like, what could change and what are we not thinking about? And just never resting on your laurels, I think would be another way to say it, where you just say, well, gosh, we've, had 6 successful exits. Certainly the next 6 will be successful, right? So that overconfidence and optimism is that idea of really humbling yourself on each new deal and pretending like it's your first deal and really looking at it from that lens, right? So part of that also looks like, the mandatory CapEx contingency budgets we include, making sure we layer in some scheduling buffers, right? Knowing that we can't always control our vendors, we can't always control the flow of new supplies and materials. And making sure we have real hard third party quotes from our vendors, our tax assessor, our insurance company before we make any firm decisions. Because there's another great example where, we had some big wins in insurance from 24 to 25 because it was a slower season when it came to some of these extreme weather events. Our insurance went down. So you go to the next deal, you might just assume, oh, we'll get that same number again, but that may not be the case. So verifying everything. And I think the way I put it, just treating every new deal like it's your first deal and you got to get 100% of it right, will help you avoid that overconfidence optimism bias.
For sure. Next is sunk cost fallacy. So this is again very, very, very easy to do when you're buying, especially when we're buying 10, $20 million properties. As you get so far down the road, you could have hundreds of thousands of dollars tied up in a property. And then you find something that is fairly significant that can really jeopardize the deal. Is very, very easy to think, oh, you know what, we have X amount of dollars already invested. Let's just keep on going.
Yeah.
And so it takes a lot of discipline and we'll say experience to be able to say, well, you know what, I'm not, it's not worth it to take this risk because,
Yeah.
the question that I got from Keith Cunningham, he wrote this book, The Road Less Stupid, really smart
Yeah.
guy that
Yeah.
he actually made 100 million, then lost it and then made it back. So it was a really interesting story. And one of the things that he talks about is, it's more important to not do stupid things than to do the right thing. So it's like good.
Yeah.
And so his whole thing was that, he'd ask three questions in every deal, and it's good to continue to ask them even when you're about to close on the deal. You got to ask yourself, what's the upside here, what's the downside, and
Yeah.
can I live with the downside? And that could have changed what the downside is after you found out more information after due diligence.
Yeah.
And so you really got to look at it objectively and say, you know what, how significant was the shift that happened even after you have, a lot of money in a deal, and does it
Yeah.
make sense or not? And then make a sound, discern decision.
Yeah. I mean, we had one recently, right? Where, when we talk to brokers, we always let them know that, when we submit an offer, we're submitting our best offer and we do not plan to retrade. Retrading being where you go back and renegotiate the contract. But of course, we let them know that, the one exception to that could be something that's uncovered during due diligence that you didn't know about, we didn't know about, nobody could predict. And we did have a deal that we absolutely loved. And we found some things in the inspection, and it was going to meaningfully impact our investors' returns due to this additional cost that had not been anticipated. And, the broker simply didn't know the information. It wasn't like there was any shady business going on. But as a team, we met and we decided that this will be an example where we're going to have to go back and retrade and renegotiate the contract, and we're comfortable walking away if we can't get what we need to make this deal work. But if you looked at that deal, I mean, we probably spent 70, 80 hours as a team underwriting and reviewing it. We had done 2 or 3 trips to the
Mm,
property. We had spent money with contractors. So to your point, we had invested probably close to $100,000 in time, effort, and energy on that deal, but we were willing to walk if we couldn't get that done. The sunk cost fallacy shows up in so many places. I used to talk to my real estate agents about it at my prior business because, sometimes you'd have that buyer, you're on your 80th showing and they still haven't bought a property. Likely best to cut ties and go find 2 or 3 other buyers that have intent and will buy from you, right? But after you've invested so much time, it's harder to do than it's much easier to say than to actually do. So, having preset kill criteria, just things that you will not deviate from, and then having that investor committee come back in and really revote on any major deltas or concerns before we proceed and move forward. But I think for us, Mark, I mean, every time we make a decision, we're always asking ourselves, will this benefit our investors, or on the resident level, will this benefit the resident? If the answer is no, we're not going to do it. But that's to me, this sunk cost fallacy is the easiest one to fall into if you're not super careful.
yeah, for sure. The next is loss aversion. So this is where people are twice as motivated to not lose something than to actually gain something. So twice
Yeah.
as motivated. So it's interesting. The pain business. So the painkiller business is twice as profitable as the vitamin business. It's,
Mm.
it's interesting is because, the reality is people they would pay twice as much to not feel pain, and this happens all the way through the sales cycle, right across businesses. And so people don't want to lose. And so the reality here, when you're in a deal, if you've lost some money, you could have, in the back of your mind is like, I'm just going to hold on to a little bit more and I'm going to make my money back because you don't want to
Yeah.
lose.
Right.
But you got to constantly ask, what's the upside? What's the downside? And can I live with the downside?
Yeah, that's right. Absolutely. So having an exit decision grid, like when do we exit? When does it make the most sense? Act on the math, not on the feeling, right? And having a firm decision making process in place to help you make those decisions. Herding is the next one, right? Which looks like copying the crowd and sort of saying, well, because the crowd's doing it, that's consensus. And I would say one of the clearest examples of herding was really the overheated market that occurred post pandemic up through 2022, really kind of midway through 22, where there were more trades in 21 than there have been. I mean, it was like well above average of volume of trades. And, I always think about Warren Buffett's famous saying, when everybody's greedy, get scared. When everybody's scared, get greedy. And that was a market where now looking back, it's easier to see. But, the signs were there that deals were trading at unrealistic pricing valuations and, things would change. So not following the crowd, having that disciplined approach. And these are the things we do. And if I always think about one of our number one golden rules, right? The deal has to cash flow on day one. There have been some deals and we got pretty close to thinking maybe we'll make an exception on this one, but then thankfully we always remind ourselves of those golden rules. No, if it's not cash flowing on day one, we don't do it. So another good example would be just an article comes out and says this is the best market for multifamily investing, and you just dive in head first without doing your own research and making sure it fits your investors risk profile as well as our own. So making sure that we're looking at supply maps in every investor committee meeting. When you drive through downtown, if you see 150 cranes, putting up new buildings, maybe that's a market we should avoid, right? And so just making sure you're not following the crowd, you're following your discipline model and approach.
Yeah, there's a good story. There was a kid at school, and the teacher asked the classroom, uh, if there was a math class, and the teacher asked if there were 8 sheep in a pen, and one jumps out, how many sheep are left? And the student raises his hand, and he says, "Oh, none." And the teacher says, "Oh, no, that's not true. There's 7 in there."
Right.
And she's like, you don't know math." And the
Mhm.
students stood up, looked back. He's like, "No, no, ma'am, you don't know sheep."
Yeah.
Right.
Yeah.
And
Yeah. Yeah.
the reality is there's none left in the pen, because sheep, they follow each other, right? And it was
Yeah.
like,
Yeah.
it
Yeah.
was just such a good story, because the kid understood people, and
Yeah. Yeah.
how, and the herd mentality. And it's so true in real estate. It's like, if everybody's going one direction, people just follow, and there's like a real pull. There's a pull there when you see everybody else doing the thing, and it takes a lot of discipline, and we'll say surety of what you believe, to be able to go the other direction when all the other sheep are jumping out of the pen, so to speak.
Yeah, that's right. No, I love that. The next one is that's a great. I'm going to keep that one in my back pocket. But the availability heuristic, right? So kind of like a really great story is greater than the reality of the deal, right? So one great lease trade out does not make your whole pro forma, and so that's something we do occasionally see where for example, we might get an offering memorandum from a broker and they're sort of saying that you can get this much more in rent if you renovate this unit. But if you dig into their rent roll, you see that they got it one time. So a great example on a deal in Noonan, they had done it 18 times. So it
Mm.
was like, okay, that we can use that data, right? Because they've shown time and again that they can achieve that number. In this particular case, this group had renovated some units. We plan to renovate them to a slightly higher quality, but we knew we can get that rent because they had done it 18 times. But if one just shows up, you can't use that as your future rent growth model, right? Like you have to go back and really dig in. So, require unit weighted comp sets, affordability checks. So that's top of mind for us, Mark. In fact, the common thought process in the industry is 35% rent to income ratio. We really like to see 30 to 32%. We want to be very affordable in that market. We do not want affordability to be the reason people cannot rent from us. So, just making sure that, one good story doesn't outweigh the actual data behind the deal.
Yeah, but 100%. And So yeah, moving forward here, what are we at here? We're at number 8. We got two more here. So we have the narrative fallacy here. So
Yes.
this is where the story that you hear is not aligning with what the data is. And so this is where it's really important to separate the story from the data. And last but not least, John, you want to take her home?
Yeah, so the status quo bias, right? So sort of overvaluing what we own and resisting needed changes. So in practice, what that could look like is, keeping an underperforming vendor because of past history, right? They've done a great job in the past, and perhaps just something's off, right? So, sticking with the status quo, I think, is something. And so very early on, as we started thinking about what we wanted our business to look like, and kind of starting with the mission, the vision, and values, and the fundamentals, one that we wrote down is we don't just chase the status quo, right? If there's a better way to do something, just because other operators are doing it this way doesn't necessarily mean we should do it that way. Now, we also look to not reinvent the wheel. So if we see something that seems to work really well and we research it, we'll implement it. But just making sure that, you're looking at, are we providing the best possible experience? Are we making the best possible decisions, and not in, just following the status quo, right? So, going back to that vendor example, the fix for that is just yearly rebids, budgets, and making sure you're holding everybody accountable to those budgets on payroll and the contracts that you negotiate.
Right on. So yeah, and this is something that we keep on moving forward from an assessment standpoint. So we look at not only the beginning, but then we're looking through the deal in regards to constantly analyzing and updating. And I think that's where we call them after action reviews is
Yeah.
what we look at. And so when we actually do deal and we close on it, we look at it, it's like, okay, what were some of the things that we did well that we can, or some of the things that we can improve on that we can really look at for that next deal. And I think that's where every deal that you do, you can learn something from it. And by doing that in that cadence and in that rhythm, it actually it polishes your skill set so that you can constantly, we will say, make fewer and fewer or get tighter and tighter in
Yeah.
regards to your decision making.
That's right. Yeah, so just some key insights, right? Bias can be predictable if you're aware of what those biases are. So build systems that sort of expect and anticipate those bias and help you mitigate them using external data and pre-committed rules versus using your gut feeling. And, having those after action reviews where you're recording dissent, tracking errors that you may have made, or leaning into the successes that you had and doing more of those things, right? So it's all about systems and process at the end of the day.
Well, John, this was, I think this is very valuable. If anything, if you could take one of those 10 and really, think about that in your next investment decision, I think that could save you
Yeah.
in the long run. I think that it's something that even if you know them, it's one thing to actually slow down and think about: is it impacting you? Is it influencing you in your decision or not? And I think if you just go through the process, you go and write down the 10, and it's like, are any of these influencing me right now? And can I look objectively at the investment and make a sound decision? I think if going through this, you'll just over time you'll make more and more wise decisions, and over time you'll do much better financially. So again, guys, if you'd like to learn a little bit more about how you can partner with Faris Capital Partners and see what a potential deal actually looks like, you can go to fulloutinvesting.com. Thanks for tuning in to the Multifamily Investor Playbook. We love and believe in you guys. Keep dreaming and investing big.